Hello, everyone, and welcome to the latest LPL Market Signals podcast. Jeff Bookbinder here, your host for this week with my friend and colleague, Lawrence Gillum. It's a special edition of the Market Signals podcast because we are rolling out the 2024 Midyear Outlook, at least part of it. Lawrence, thanks for joining this week. How are you?
Oh, I'm great, Jeff. Just trying to stay cool and inside these days. But yeah, really excited to talk about the mid-year outlook. There's a lot of great pieces, a lot of great teamwork that went into this, and excited to roll it out.
Yeah, me too. It's a lot of fun to work on. It's even more fun to roll it out. So there it is in all of its glory. The 2024 Midyear Outlook available on LPL.com as you are listening to this. We are recording this on Monday afternoon, July 8th, 2024, but we're going to put this out on Tuesday morning after the publication is out. We certainly do not want to front run ourselves. So we'll spend most of this podcast just talking about the outlook and showing you some of the charts, but we'll do a little bit of market recap and week ahead as well. So speaking of the market recap, let's do that here. First, we had another positive week for the S&P 500. The S&P was up 1.6% on a total return basis. The all-time high count is at 34. It's 34 record highs, maybe making a run at the all-time full-year record. We'll have to see what happens in the second half. Tech, I sound like a broken record, but tech was the leader again. It was a holiday shortened week, so there really wasn't a ton of news to change the dynamic. We're in a very positive seasonal period, and tech has been working, so tech continue to work. Although also worth noting that consumer discretionary was another big outperformer, as Tesla was up 27% for the week, believe it or not. The growth style continues to dominate value. Generally speaking, the U.S. continues to lead developed international markets, although we did have a pretty good week in Japan last week. And, the French election uncertainty, markets got a little more comfortable with that situation last week. So we got some nice gains in France, but that market still hasn't dug itself completely out of its recent hole. And in general, we just think Europe is going to struggle to keep up with the U.S. Political uncertainty or no, the economics and the earnings picture continue to point to favoring the U.S. So turning to the bond market, that's your baby, Lawrence. We had really big gains. I know we had some weak economic data. That was certainly part of the story. What do you think of that move?
Yeah, so we did have a pretty good week last week, and most of that week came on Friday, actually, after the jobs report. At first blush, that jobs report came out and beat expectations on the headline number, but I think markets were really focused on those negative revisions, showing that the job market is softening. It's not falling off a cliff or anything that's too concerning at this point, but it has got into better balance, as we like to say, and that helped the bond market, helped push yields a little bit lower. 10-year Treasury yield was down about 10 basis points last week. Most of that did come on Friday, but that did serve to generate positive returns for most of these fixed income markets. The aggregate bond index up about 0.7%. Still negative for the year, barely. I think we've got a little rounding issue on this screen, but we do have some slight negatives in the bond market this year, but slowly crawling out of the hole that took place in January and February after a lot of that repricing that took place based upon Fed rate cut expectations. Looking at just the individual sectors, mortgages were up about 20 basis points, down about 30 basis points or so on the year still. So once again, trying to claw out of that big hole that a lot of these markets started in. High grade corporates up about 50 basis points, high yield bonds up about 30 basis points. So corporate credit performed well last week, despite the fact that there was some softer economic data, which again is just another kind of data point that we look at to see that right now the economy is still doing fine. Markets aren't overly concerned about this softening data. Spreads have stayed relatively contained. So it's kind of this orderly slowdown, if you will, and that's been good for both equity and fixed income markets. One last comment, the preferred space It's an area that we've had active exposure to over the past, call it, year or so, up about 60 basis points on the week, up over 12% over the past year. That's looking like an equity market type return out of the fixed income market. So that's been a good space in an area that we continue to like given current valuations.
Yeah, that's been a great call, no doubt. And certainly, focusing on the US has worked for us as well in the first half. So we'll see if it continues. More thoughts on that in a minute, but yeah, great run for preferreds for sure. Turning to commodities, I mean, oil certainly is in a pretty good spot seasonally. Actually, stocks are too in first half of July. With the summer driving season starting up, that's been positive. And then unfortunately, the geopolitical environment is still quite treacherous, and that's been positive for oil too. So it's made it a little bit of a run here, up another couple percent last week. LPL research continues to like the energy sector here for the second half. And then the dollar. Here's an interesting one. We don't talk too much about big moves down in the dollar. There you go, 1% move down. Certainly, that is welcome news for the yen, which has really struggled to find its footing. It has a little bit here over the last few trading days, and that certainly was recognized with a solid gain in the Nikkei last week. The dollar was reacting to the increased chances of the Fed cutting rates in September, or the increased chances of 2 cuts this year. We'll hear more from Lawrence on that in a bit when we get to the outlook and specifically the fixed income section. So let's get rolling so we can squeeze all this in. Lawrence, we got the economy first, which, for the headline, it's expected to slow down. I had this great idea this week to bring in, Jeff Roach and go through have each subject matter expert go through each section, but Jeff went ahead and went on vacation, so that spoiled that plan. I guess we're just harder workers than Jeff. It seems. So we'll do his section and the best we can, and then we'll get into our sections where we'll be certainly a little more comfortable. So starting with kind of why this economy has been so resilient in the first half. I think the mortgage refi boom might be the biggest reason. You also had some stimulus certainly left over from the pandemic, but this chart shows you how much in equity at the top that homeowners have pulled out of their homes, equity extraction from refinancing. And you see that big burst in like 2022, right? Late 2021 into 2022. That's clearly put more money in consumers' pockets and has facilitated more spending. Same thing with the bottom chart here. Refinancing activity reached a record high in 2021. That, locking in those low mortgage rates has given consumers more money to spend. It's as simple as that. So, this is such an important theme here to explain the first half that Jeff put several charts in on that. So this next chart shows you that, the job is harder for the Fed because they are dealing with a lot of mortgages that are not interest rate sensitive or homes that don't have a mortgage, right? That's the left-hand side showing you the percentage of consumers in 2022 that had mortgages versus no mortgage. We know there were a lot of cash buyers back then. So that reduces the interest rate sensitivity of the economy and of consumers, and therefore makes the Fed's job a little bit tougher. Of course, fewer people are renting. They're impacted by inflation, certainly. Here's another way to look at this, and then I'll turn it over to you, Lawrence, for your comments on this theme. The light blue line is basically mortgage obligations, and as a percentage of disposable income. And you can see here, it's essentially never been as low, not at least in modern history. Come back, obviously, off the lows as interest rates have risen, but still the percentage that people are putting toward their mortgages in aggregate is quite low. And that just, again, given consumers more spending power. The black line isn't really that interesting. The consumer debt service ratio, it's a broader measure of consumer debt. It is kind of in the middle of its historical range, but you might think because interest rates have moved higher that it would be at the top of its range, and it's not. So maybe there's a positive out of that too. Thoughts on this, Lawrence?
Yeah, I would say that the housing market theme is a theme that we've been playing in the fixed income markets as well. We've had an overweight to agency mortgage-backed securities because of the fact that there are fewer mortgages being refinanced and there's being fewer mortgages originated. So the supply of mortgage-backed securities has come down a little bit. So that's one of the thesis behind our overweight, as well as valuations too. So this is an area that we certainly pay attention to on the economic front, but also on the investment side as well. So to your point and to Jeff's point, I mean, this is a pretty important topic, which again is the reason why we have so many charts in this outlook. But it's one of those things where it's one other thing. These are aggregate numbers, so there are going to be folks that are going to be more or less impacted by these numbers. But I mean, just by and large, you look at this chart here, and I mean, it's no doubt that the Fed is trying to slow aggregate demand by making things more expensive, but this chart alone is saying that they're not able to because of the mortgages that a lot of these consumers have and look to keep for longer than they have historically. I know I don't want to give up my 3% mortgage anytime soon and refinance at these higher levels. So eventually, I think we're all going to have to or have a mortgage with a higher interest rate than we've had over the past decade or so. But right now, it feels good to have a 3% mortgage rate on your home.
Yeah, and a lot of people in this hybrid environment are also saving on commuting costs. So including myself and occasionally you, Lawrence. So that's another support. So good stuff. Let's move on to inflation. Obviously, that's been a big story for markets. Here's good news. This is the employment cost index, and Jeff always talks about how this is a really good measure of labor costs, but it's also stale. It comes with a bit of a lag. So you're not getting a June read here. You're not even getting a May read. But nonetheless, I think it's very instructive to see how much progress we've made since the peak. Right, this has come off the highs quite dramatically. Actually, the black line is services inflation, and that's been trickier. And then the light blue line is goods producing labor costs. Services, jobs are more important obviously for services inflation. Wages are a bigger component of services costs. So that's been the sticky piece and the one we really want to see move lower in the second half. We've made progress here. If we take out housing and do core services inflation ex housing, the blue bars, light blue bars, are just month over month. And the June reading was, or I guess this is May. The May reading was nicely down, and we should see another down reading or tepid reading next month. Year over year is the darker blue line, and it just started to tick lower. So I think that's why Jeff used this phrase, turn to corner. Actually, that's the theme of the outlook. Still waiting for a turn. It looks like a turn might be here, but as we continue to hear from Powell, we need more evidence to be confident that inflation is moving towards 2%. So here are the forecasts. I'll let you, Lawrence, pull out anything here that you think is interesting, but I'll just start with the GDP line. Look, we expect a slower economy, but not a recession. We don't think recession is coming in the second half. It may not even come early 2025. Based on the resilience of this economy, it appears that a slowdown will be gradual. So that's our call. Of course, as you know, Lawrence, better than anybody, that'll probably put some downward pressure on inflation and on interest rates. So what do you think here is worth calling out, Lawrence?
Yeah, it's just our rate cut expectations. I think what I think we did particularly well in the first half of this year is not buy into this notion that the Fed was going to be in aggressive rate cutting mode in the first half or even throughout 2024. Our view is maybe we get 2 rate cuts this year. I think we penciled in 3 possibly at the start of the year, but we certainly did not agree with the 7 rate cuts that were priced into the markets back in January. So I still think that we're in line with Fed expectations in terms of rate cuts, and we do think that we're going to get we'll get a pair of 25 basis point rate cuts this year, which to your point should help with the bond market, which should help with consumer loans. It should help. We don't think it's going to reignite the inflation story, but we do think it's going to help the Fed achieve its dual mandate as it relates to the labor market. We did see some slight weakening there, so that should allow the Fed to start to cut rates, sometime this year.
Yeah, the market certainly priced in a pretty high likelihood of September based on the softer data last week. So we'll see. Two cuts would certainly be consistent with our economic views here. I think it's fair to say. The core PCE, Jeff has a 2.7 for fourth quarter. That's one I think maybe we could even do better. We'll have to see, but that's our forecast. So I think we'll keep moving and get into stocks. Certainly my favorite section of this report. I threw the S&P 500 chart in here because I just couldn't imagine a market signals without an S&P 500 chart. So here you go. Closed on Friday, the holiday shortened week, at 55.67, which, as I mentioned, was I think it was a 34th record high this year. The RSI 14 is how we measure overbought conditions when it's over 70. It's now 76 and change. So this market is overbought. We've been saying we need a pullback for a while, and we're repeating that in the outlook, frankly. Our view is more buy the dip and wait for a correction or a pullback rather than add to equities now. So yeah, there's a little bit of a cautious tone to the piece. Certainly we think some of the gains in the first half have pulled forward potential gains in the second half. We're starting to see a little bit more 52-week highs, but that middle pattern, the middle panel, the green bars, only about 4%. That tells you that this is still a narrow market. Another reason to think, we'll have a pullback or a correction once the AI theme starts to wane a little bit. That we haven't really seen that yet, but at some point it will. So let's go into the outlook charts here now. This is first one. So as I did in the outlook back in November for the full year 2024, we identified cycles, right, to help us gauge where this market might go. So we've done the same thing here a little bit in this publication. So this first cycle is just the bull market cycle. So if you look back at all the bull markets since World War II and you see how they did the first 2 years, we're almost done with the second year. It's coming in October, right? So not quite to 2 years, but we'll say close enough. On average, 2-year bulls gain 60% for the S&P. This bull's up about 53, 54, something like that. But if you look at these blue bars, bull market by bull market, you see 09 and 2020 were especially strong. Well, that's because the bear markets that set up those bull markets were really nasty. And when you have a sharper and bigger decline, it sets up a bigger rally. So if you take those out, the average isn't 60, the averages are about 53. Well, we basically have that already. So, we're not necessarily saying that stocks will be flat in the second half, but certainly this analysis suggests that any gains from here are going to be tough. This next cycle, certainly this is one that Lawrence can relate to, is around Fed pauses. So how does the S&P 500 do historically when the Fed is neither cutting nor hiking? Right? Here's another anniversary. We're almost at the 1-year mark since the Fed last hiked. We've seen no changes to the Fed funds rate since July 23rd of last year. It's one of the longer pauses. The horizontal axis here is the length of the pause. So we're at right around 340 days now. The vertical axis is the S&P 500 performance during those pauses. So this is also one of the best pauses we've had. that number actually now is a little bit better. Call it 21, 22% during this pause. Here again, same message. We've kind of, we don't know for sure, obviously, if we're going to get a cut in September, but if we do, probably not a lot of upside between now and September. It's typical in any given year to have a correction in the summer or early fall. So we think we're going to get that again. It's just hard to know when exactly it's going to come. Maybe around the election, maybe earlier. We'll see. But this is just another way to say this market's kind of priced in a lot of good news, and may not have a lot more ahead of it in the second half, especially if some of these risks start to get priced in. By the way, if some of these risks aren't priced in, or we get a benign outcome to some of these risks, geopolitical, election, etc., then we certainly could see upside to the S&P 500, potentially even meaningful upside. If we're going to get gains in the second half, it's probably going to come from earnings, because stocks are expensive. We either need the earnings to rise and reduce the PE, or as you'll see on the next slide, we need rates to come down. This is our updated earnings forecast. We just raised these. So we are taking our valuation assumptions down a bit. We're now at $240 and $260 per share in S&P 500 earnings for 2024 and 2025. We were previously at $235 and $250. Frankly, we and many others underestimated the earnings boost from AI investment. That's the biggest piece of this, and certainly the economy has been a little more resilient than most analysts thought. So at these numbers, we can keep a PE ratio in the neighborhood of 20, which we think is fair given the fundamentals, and still maybe maybe have a little bit more upside in the second half. So I mentioned that valuations can get support from lower rates. So this is a way to see that. We've showed this chart before, the equity risk premium. It's basically comparing the PE ratio to treasury yields, right? You just have to invert the PE to align the denominators, and you can have kind of an apples to apples comparison. So essentially, the earnings that stocks are spitting off are less than the income that treasuries are spitting off. So you've got a higher, essentially, amount of compensation for bonds than you have for stocks, right? If you align income and earnings. So valuations are high. We've been saying that for a while. They're not great timing tools. However, over time, valuation metrics certainly matter. And this is one where we're either going to have to grow our way out of it with more earnings, which is certainly possible, or we need lower rates to increase the value of future earnings. Any thoughts on the equity risk premium here, Lawrence? Where could rates go?
Yeah. So our view is that we will likely see lower rates throughout the course of this year, but absent a broader economic contraction, we're probably not going to get much lower yields, which we'll talk about in just a second. But I think the main point that you made earlier about these types of valuation metrics not being great timing tools is an important one. This is certainly not to suggest that you sell all your equities and buy bonds, because it's not how it works. It's just not, that's not what the point of this slide is. But this shows that there's, I would argue there's a lot of value in fixed income right now.
Oh, absolutely. So yeah, we have a slight preference for fixed income, but over equities, but we're still neutral equities. That extra fixed income allocation comes from cash. So, I've used the phrase riding the wave, right? Technicals haven't given us a reason to sell equities just yet. So we're neutral despite high valuations. The earnings has been, frankly, I think stronger than virtually any Wall Street strategists expected. And, that might just carry us higher here. As we wrote about in our last weekly market commentary last week, the first half of quarters has been very strong over the last several years, and that aligns with when you get the bulk of earnings reports. So before we get to bonds, let me do a quick election. I feel like this is a public service announcement, because so many of you think, well, if I don't like the outcome of the election, I'm going to sell my stocks. So we feel like it's, we're almost obligated to show these studies every 4 years. So here you go. Stocks can do quite well under Democratic or Republican presidents. Markets tend to like gridlock. We'll see how much they like it in France, but markets tend to like gridlock in the US. Certainly you see these solid gains on the right-hand side of the blue set of bars and the red set of bars. It looks like we're probably going to get gridlock, but there is a chance. I don't want to say it's a low probability, but at least polling and the betting markets are suggesting maybe there's like a 1 in 3 chance of a Republican sweep, maybe a little bit more than that, just based on the the House, the sort of who's defending seats in the House. We'll have to see. It's obviously early, and we this is hard to predict even the day before the election, frankly. But there's a good chance we'll be in one of these positive bars. But you know what? Even if we're not, it's not a reason to sell, because look at this next study. The the line that's way north, way up and to the right, is if you invested $100,000 in 1950 and stayed with the market that whole time, you'd have over 32 million. If you invested only when Democrats were in the White House or only when Republicans were in the White House, you did a lot worse, right? 1 million under Republicans, 3 million under Democrats, and change. Just the message here, stay invested. Corporate America and profits are very resilient, right, to whatever political environment it might get. We've seen this the last several administrations where stocks have done well, even as we flip back from Republican to Democrat, and vice versa. So important message, especially for advisors listening and looking for stories for clients. So here's the bonds. So Lawrence, I'm going to let you just take it away. You kind of hinted at it a little bit, couple cuts, maybe in the second half, and yields may be lower, but not a ton lower.
Yeah, absolutely. One comment though on the election, real quick. If you go back to that slide where it had the Democratic presidents, Republican presidents, and right, just before any sort of hardened partisan comes in and says, "Well, we want Joe Biden to win just because of the blue line there," it's done better than the red line. The difference really comes from 2008 at the end of the because of the global financial crisis.
Good point.
Take that global financial crisis out of this equation, and they look pretty similar. So. I think that's that's the message, is that markets don't care about politics; they care about policy. And regardless if it's a Republican or Democratic president, you tend to get similar type returns. But that 1 year really kind of makes it seem like the markets have done better with a Democratic president. When I mean they have, that's what the data shows. But it's because of that 1 year. So if you don't have global financial crisis in your outlook, you're probably going to get similar type returns regardless of who's president.
Totally fair. Yeah, 2001 was certainly a little bit of drag for the Republican side as well. Poor Bush 43. So, but good point. Yeah, he had to live through 2 pretty big downturns there, in the White House. So let's go back to bonds. But yeah, thanks for adding that color. Pretty upbeat outlook for bonds. I thought you guys are downbeat. What
I know. I'm shedding the pessimistic title that a lot of fixed income investors are saddled with. I think, or we think, that the bond market is in a really good spot for really 2 reasons. And this first chart is probably the wonkiest one that in my section, but I would argue also one of the most important ones. This is showing what the markets are expecting in terms of the Fed funds rate over time. It's called the neutral rate. The neutral rate is neither restrictive nor accommodative. It's just kind of a neutral interest rate. And markets are saying that the Fed is only going to be able to take the Fed funds rate back down to around 4%, which is a pretty big difference from what the Fed has told us in their remarks and through their statements, that they think 2.5% is the neutral rate. The 4% level is notable for 2 reasons. One, if the markets are right and the Fed only cuts the Fed funds rate down to around 4%, that means that income component that we finally saw come back into the fixed income markets is going to stick around for longer. That makes fixed income a more durable asset class. It means yields are going to stay elevated relative to history for longer than perhaps we were expecting this time last year. So that just means that there's going to be a lot of income opportunities within the fixed income markets if the markets are right. If you want to go to the next slide, I would say it's important because the income component has been the biggest contributor to total returns over time. This is looking at the Bloomberg Aggregate Bond Index, which is that main fixed income index. That light blue line, that's the price performance over time, whereas that solid blue line or black line, that's the total return. That difference represents the income component. So overwhelming majority, 90+% of total returns come from income. So if the markets are right, the Fed doesn't cut rates aggressively because they don't need to, because there's not a deep economic contraction. The income component is going to be a pretty positive contributor to total returns on a go-forward basis too. So that gets us excited because the fixed income markets are generally lower risk. There's a lot of high-quality fixed income options out there that are yielding 5.5%, 6%. And that's a really good return if you're an income-oriented investor. So as long as the Fed doesn't need to cut rates, the income component we think is going to be a big contributor to total returns on a go-forward basis for longer. The next slide that I have on here is that if the markets are wrong and the Fed does need to cut rates, fixed income has an optionality associated with it that cash does not. Right. So if you look at cash yields, and I should preface this by saying cash is absolutely an attractive asset class again, especially for those investors that have like a short-term time horizon. If your time horizon is measured in quarters or even a year or two, cash is a great option. But if your time horizon is measured in years, fixed income has been the better performer relative to bonds, or I'm sorry, relative to cash, because of that optionality. If things go bad, if the Fed does need to cut rates more aggressively than what's priced in, you get that price appreciation as well. So the story out of the fixed income markets is, you get the income component, and hopefully that income component stays elevated for long periods of time, meaning the economy is on stable footing. The Fed doesn't need to aggressively cut rates. That's a great scenario for income-oriented investors. But if things do go sideways or south in the economy, when the Fed has to cut rates more than what's priced in, you're going to get price appreciation out of bonds that you don't get in cash too. So the takeaway is really there's two levers that bonds have going for them right now that is one of the reasons why we're pretty excited about fixed income. Is you got the income and then you got the potential price appreciation if things don't go well in the economy. So to your point, we do like bonds over cash. We think the high quality fixed income, agency mortgage-backed securities, treasury bonds. We like the short to intermediate part of the corporate credit curve. We don't like the index broadly because it has a lot more interest rate sensitivity to it, but you're not giving up a lot of income just to own, corporate bonds with a 3-year maturity or so. And then we like preferred securities again as a way to help generate income. Right now, you're looking at a portfolio of high quality fixed income that can generate 5.5%, 6% type income, which is something that we really like. So pretty positive on the outlook, as you mentioned. It's not often that we have this kind of dynamic in the fixed income markets. So it is, we think, a pretty positive story for income oriented investors.
Yeah, I can't believe as an equity guy I'm saying this, but I think it's easier to, paint a picture of a, mid-single digit gain in the second half in the bond market than it is in the stock market. Hopefully we get that out of both asset classes. That's certainly possible. But the bar just keeps getting higher and higher on the equity markets, which is why we're in this position where we think it makes sense to wait for a pullback rather than getting too aggressive at this point, even though momentum has been very, very strong. So thanks for that, Lawrence. Frankly, I think that was pretty good in getting through all that in the short amount of time that we just did. So, but we'll do the week ahead quickly. We're running up on our allotted time. I think clearly the CPI and the PPI are what matters most, but we actually got this New York Fed 1-year inflation expectations number this morning, and it was right at 3%. So I think that was somewhat encouraging. The Conference Board's version of that has the University of Michigan's version of that have been kind of around that same 3% number, but they've been moving in the right direction. What are your thoughts, Lawrence, on the inflation data this week?
Yeah, it's going to be a big week for the inflation data. CPI on, what is that, Tuesday or Wednesday? And then we had PPI this week as well. So big inflation data dump this week. But I think markets are really going to be focused on Chairman Powell's congressional testimony. He goes to the Senate, I believe, and correct me if I'm wrong, I probably get this mixed up, but I think he goes to the Senate tomorrow and then the House on Wednesday.
I think that's
but
right.
those will be big meetings for sure for markets to see if the tune has changed from the Fed, because we have gotten some softer economic data, some better inflation data than what we got just last month. So it'll be an interesting kind of topic when that undoubtedly comes up in these congressional testimonies on the path of interest rates.
Yeah, and so I mentioned we wrote about earnings last week in the weekly market commentary. Earnings season starts Friday with the big banks. We get JP Morgan, I think Wells Fargo and Citigroup. So that'll be very interesting. The banks, make up a pretty decent sized weighting in the well, not just in the financials sector, but the overall S&P 500. So that matters, and hopefully will get us on our way to a double-digit earnings growth quarter for Q2, which would be the first time we've seen that in a couple of years. So we think it'll be a pretty good earnings season and has a good chance to be supportive of stock prices in the near term. The last thing I'll mention about this week, that jobless claims are getting more and more interesting because they have ticked higher and kind of stayed a little higher. Our forecast is that we will see some weakening in the labor markets in the second half as the economy slows. We're getting close to triggering some of those historical moves in jobless claims that have been consistent with a recession. So, we'll see that those signals tend to take a while to play out, but certainly we got to continue to watch the job market. Unemployment is still low, even if it ticks higher. So really, we don't see much to worry about now, but that is something else to watch this week. So let's go ahead and stop there. So thanks, Lawrence, for helping me get through the outlook, or at least a chunk of it. By the way, it's not just those sections. We have a section on geopolitics. We have a section on commodities. We have a section on currencies. We have a section on alternative investments. There's a lot of stuff there. So as I'm sure many of you have seen already. So check it out. I hope you like it. Thanks for spending some time with us to walk through that and squeeze in a few other things. So thanks again, Lawrence. Everybody have a wonderful week. Hope you all had a great 4th. And we will see you next week on LPL Market Signals.